Kevin Carney, welcome to the podcast. How you doing?
Thanks for having me. I'm doing well, thank you.
You bet. So tell the audience about, who you are and your background in finance and we're gonna take these folks for a journey today. I have a feeling.
Okay. Well, I'm Kevin Carney. I own Pier One Insurance Group, insurance and investments. I started my career with Dean Witter, Morgan Stanley Dean Witter. I was a stockbroker, and that served me well. I met so many incredible people all over the place, and I'm still meeting incredible people in my current position. And now I'm on the podcast.
Yeah. How long have you been running your own operation there, Kevin?
12 years. I've been in the industry for 12 years. I've run my own operation for 6 months.
Okay.
Yeah, or 8 months, or I think something like that. Time kind of flies because I fell in love in the meantime. So,
oh my gosh! Oh,
yeah.
That's a time investment.
That's huge time investment. Huge.
Well, that's great. That's great. I want to talk to you about. I have a ton of questions for you. Let's say we have a new skilled trade professional. Doesn't matter what it is: electrician, plumber, welder. Doesn't matter. There's a gazillion different jobs out there, and one of the things that I hear over and over from both skilled trade employers as well as workers is that if you find somebody who's talented, to keep them, there's a lot of other reasons besides money to stay with a company, but the employers are really keyed in on trying to keep the wages competitive. And what we're finding is the wages are going up pretty quickly. So you'll get somebody it depends on the state where you're located, but they'll be making starting out at maybe $15, $20, $30 an hour, if you're on the West or East Coast, big markets. But if they're good, I mean, they're shooting up quick. I've seen some of these young folks that are just getting started after 2 years with overtime and stuff. They're teasing, 6 figures already. Mm-hmm. And one of the things that seems to be the common denominator is, we're not offering any real financial skills training. So all that framed out, what are some things that low-hanging fruit on the financial training side, or somebody came to you and said, "Hey, Kevin, I need some help with my money, man. I just can't get this thing straight, and I'm making great money, but I'm still broke." So what would be the advice you would give them?
The first thing I'd suggest is max out that 401k, max that baby out, because that's automatically 5% or 10%, whatever, because your employer will give you a match for whatever dollars you put in. So if you put in $50 and they do a 50% max, that's $25. That's $25 profit you just made by participating in your 401k. Or 403B if you were at a nonprofit organization. That's what it's called, 403B. At nonprofit. Teachers have participate in 403Bs. At for-profit companies, it's 401k. Yeah. Mm-hmm. I would say right away, max it out. And then once it's maxed out, then look into an IRA. 401k, then IRA, and then annuity. Annuity will give you, protect your upside or protect your downside while giving the benefits of an upside. If the market goes up 50%, you go up 50%. If the market goes down 50%, and you have your downside protected, and 10%, then you go down only 10%, not 50%, like the market. So I do 401k first, IRA, then annuity.
So that assumes that they have money to invest. So what do you recommend as far as budgeting? Do you help clients with that, or are you kind of upstream of all that? Let's say somebody wants to invest and they're making good money. They're sharing with you how much money they're making, but they've got as you said in the workup I read you submitted, it's like debt can just steal from you, right?
Oh, it's the biggest thing for them. I tell you what, if they know me and I'm in their life, they're going to save money. I'm going to demand that they save money, because this credit card debt is ridiculous. Credit card debt or new car debt. You don't need a new car every couple of years. You don't need a new car. You just drive what you've been driving and watch your wallet grow, watch your bank account grow. If you want to see something fancy, you watch that. But anybody who knows me probably has money in the bank, because I'll chastise them if they don't. Yeah.
Do you have any budgeting tools that you turn people on to? I've been a proponent of an application called YNAB, but there's a lot of them out there. Is there any good tools that you recommend to folks to help them with with budgeting and getting control of the money and that kind of thing?
Well, I do that with Navy Federal Credit Union, my bank. They have a tool. It's a budgeting tool. I haven't experimented with it too much because I already have a budget.
Mhm.
But that will force you to save money. If you open the accounts like I tell them, if they open the accounts like I tell them, then they'll already have a budgeting mindset, and they know to pay themselves first, then they're pay off the bills, and then pay for luxury goods. They know what order these things come in. Because if you don't pay yourself first, you're lost. You're gonna
Right.
be lost.
What's your definition of pay yourself first? Because on a couple interviews I've done, that seems to be a real common thread. What exactly does that mean? Pay yourself first.
Okay, to me, that means pay yourself first. It means put some money away for 6 months for you and your wife or your kids, whatever like that. Spend the money, walk around, change, whatever you'll call it, or spendable cash. 6 months of spendable cash, just in case you lose your job. Because I come in all the time. Half these people don't have disability insurance.
Right.
So if they do, if they're in a trade where they're going to potentially get injured, if that happens, who's going to pay the mortgage? Who's going to pay the rent? Who's going to pay for the car? Who's paying these bills that come? The bills keep coming, whether or not you're in good shape or not.
Mm-hmm.
Yeah, the bills keep coming.
Yeah. So pay yourself first is basically what I call an emergency fund.
Yeah, exactly. Emergency fund.
Okay.
Yeah.
Okay.
To me.
Yeah. And that's what I talk about is, because I get asked, okay, well, how long, how much emergency fund should I have? And you said it. Basically, what I recommend is if your job totally went away, you have no income coming in from the outside world, you've got enough capital saved up where you can get it within a day or two or sooner, that you can pay all.
Or if they came to Kevin Carney for disability insurance.
Oh yes, there's that too.
I'm joking.
So well, let's talk about that. Let's talk about that. Does that? What's the value proposition on that? Because disability insurance, I've never owned. Well, let me take that back. I think many moons ago, when I was an apprentice, almost 40 years ago, they offered AFLAC or something like that. It was so if you get hurt, they give you a certain amount of money. Does it pencil out? I mean, like you get somebody that's a 20 something. What does that cost? I mean, on average to have disability insurance?
Really not that much when you think about it. Probably if you're 30 years old and you want a check for $6,000 every month, because that's how disability insurance works. It pays your check every month.
Okay.
It's probably going to cost you $100 a month.
Wow. That's cheap.
Yeah. It's crazy cheap. And when you get it, you have to get 24-hour disability coverage on work and off the job. Because if you just have it on the job, which most people do, on job only, then what if it's something at your house? Something happens at your house. You're not covered.
Right. Now, that setup, though, if you're hurt off the job, because if you're hurt on the job, you're covered through workers' comp. So that's a different animal altogether.
Yes.
But you're saying, Mike's up on the roof and cleaning his gutters out, and he falls off a ladder and breaks his leg or something like that.
Yeah. So
the process would be he just calls an 800, 1-800, I fell off my ladder, and fills out some paperwork, and they I guess you have to get a doctor's approval and all that kind of stuff.
It's PCP.
What's that mean?
It's personal care physician.
Okay.
Yeah.
Okay.
PCP.
Okay. So you go see that now. Is it an insurance paid doctor, or is it your doctor? Or does it matter?
If you're a doctor, it's no big deal, because your doctor will sign off on you being sick or whatever, and then we'll pay for you to be out. We'll pay for your doctor to meet with you to sign off on you being sick. Whenever I sign someone up with disability, I always sign them up with accident and sickness.
Okay.
Accident and sickness, because you never know if it's a cold, whatever, or if it's a broken leg. You want them both covered the same.
Yeah. Okay. Well, I guess so. $1,200 a year. Of course, they'll have their pre-existing condition stuff on there, but I guess that would pencil out, because some of these jobs these people do are, the job's paid for, but I guess if you think about it, if you go 5 years without an injury, so in 5 years you paid $5,000. If you go 10 years, you paid $10,000. But if you're racked up for 2 months, then you got that money back. So I guess that pencils out. Does it ratchet up as you get older? It has to.
If you get old, everything's more expensive when you get older. Everything
Tell me
is
about
life,
it.
disability, whatever it is. It's
Yeah.
yeah. But I tell you what, if some people can barely make it while they're at work. Now, if they can barely make it while they're working, what happens when they can't work anymore? They certainly can't
Right.
make it. And then they want a certain amount of you want a certain amount of income when you're out on disability. And if you're making a lot, you're going to demand a lot from your disability insurance. And the more you demand, the more it costs. And the earlier you
Right.
get, the better off you'll be for all kind of insurance.
Okay.
Yeah.
Well, that's good. That's good to know. Yeah. You know, if you're in a, even if you're working in a highly physical job, roofers come to mind. Roofers, that's
I
a rough,
know.
man. You
Yeah.
could not pay me enough to be a roofer. Oh, and you know, they're at work all day. They could be getting dehydrated, whatever. And they get home and now they're on their own insurance, basically. I mean, they may have insurance through their employer, but they get home and they do something around the house or whatever. They end up getting hurt. You know, I can see how that would make a good idea, you know, be a good idea in certain circumstances. Yeah.
And they got to make sure they give return of premium. ROP,
Right.
return of premium. That way they get all the money back if they don't use it.
Oh, wow.
Yeah.
Okay. Yeah. So I want to go back into investing. So 401k. So they've got a 401k. A lot of times the employers will offer that. I'm 100% behind that because basically it's free money, really. And you mentioned IRA. What's your opinion of dollar cost averaging into the market? So,
It's the only way to go.
okay. And why don't you explain to everybody what dollar cost averaging is? Because I had somebody the other day ask about that. I think I know what it is, but how does that work?
Dollar cost averaging, you're investing when the market's up and you're investing when it's down. So on average, the market is up. So as it goes down, you can buy, if the stock is $100 a share, stock or mutual fund is only a bunch of stocks in a pile. That's all it is. But so if you put $100 in and the stocks say $1 a share, well, you can, when it's at that price, you get more shares, a lot more shares. You get 100 shares at $1 a share. Because now when this goes back up, if it goes back up and the price is $10 a share, now you got 100 shares you paid a dollar for it. And you got 10 shares. Now you got, well, whatever I said. But now you got 10 shares at $100 a piece. So you can basically you buy more shares when the market's down, and then so you have more shares when it's up.
Okay.
I don't know if that makes any sense.
So you're playing statistics, basically, is what you're doing.
Yes.
Okay. Yeah. So I guess the moral of the story is if dollar cost averaging is if you're making regular smaller deposits, statistically the probability of making an investment on a down is, I guess statistically you'll get a better price on those shares if you're doing it lower amounts on a regular basis than you were if you just chunk a big amount of money in all at the same time. I guess that's kind of how I'm reading
And you
that,
keep
right?
investing. You don't depend on your own skills, your own talent, because nobody can beat the market. Nobody's beating the market. If you try that, you're gonna lose your money. That's how I was when I worked at the Winter. I was with a group, and everybody tried to time the market. Nobody could beat the market. So I said, "The heck with this group." So I got clients. The clients wanted to do dollar cost averaging because they had a retirement account like 401k or 403b, and we wouldn't that. That's how I grew my business, actually. Yeah.
So what's your target client? Like what's the type of customer that you can help the most?
If they're married, it's the woman, because women will always go with safety. That's invest insurance and all this kind of business. Cancer insurance, Parkinson's disease insurance, any insurance women buy. Women they'll be the ones who will be insurance poor. Well, and guys will drop dead before they get insurance. Except smart guys. Smart guys don't do that.
Yeah. Yeah, that's good. That's good. I guess that would be, that sounds accurate to me. Huh. Have you ever heard?
If they really care, then you just have to ask the guy. You say, what would happen if your wife and your kids were left there to pay the mortgage without you? And then you start looking at his face, and then you see what the emotion goes over his face. And he cares. He actually loves his family, his wife, and his
Right.
kids.
Yeah. Have you ever heard of a strategy called the bucket approach when it comes to investing? Have you heard that term before?
Yes,
I
sir.
thought it was interesting. Yeah.
That's
Um,
part of paying yourself first, in my opinion.
yeah. Okay. Okay. Yeah. The way it was explained to me is you have your income coming in, and then you have, if you're budgeting correctly, hopefully you have more money coming in than going out. So that's the first challenge, right? To try to get that situation going. And then the way it was explained is you have your pay yourself first, or what I call an emergency fund. And you've calculated, that any given month I need $8,000 or $9,000, whatever it is, to pay my mortgage, my truck payment, insurance, whatever, all my stuff. And then, so you put money in that emergency fund until that bucket, figuratively speaking, gets full.
Yeah.
And then once you've got that, what I've heard is 6 months of money in that primary bucket, then what you do is you have another bucket, which is your investing side. So once one's full, then you can start dollar cost averaging into the market. Is that kind of accurate what I was describing?
That's exactly right. That's exactly
Okay.
right. Yeah.
Okay.
Because you got to wait until if those buckets aren't full, then there's no point in getting the market after that, before that.
Right.
Yeah. Because
Yeah.
you still have to pull your money out of the market if you have money put in the market.
Mm-hmm. I want to talk about psychology for a minute. This is another one that comes up. So I've had a few people that I've talked to about investing, and, they're doing all this stuff right. They're the 401k, that's pretty easy because you can put that sucker on autopilot with you, usually through your employer. You tell your employer, hey, I want to divert some percentage into the 401k, and you forget about it, that kind of thing. And then you have people that have, some extra money and they want to invest, whether it be into a fund or they want to invest in a individual issue or something like that. But they freak out, like when the market drops 200 points in a day, and they're on the phone and they're saying, Kevin, the market dropped.
Oh, you must have my phone tapped.
Yeah, the market dropped. What do I do? And then, they're saying, sell it all, right?
That's why dollar cost averaging is so important.
Yeah. Yeah. So what do you tell your clients about risk tolerance? I'm sure you have a lot of conversations when you get to that point in your relationship with your clients that, you got to have that conversation about risk tolerance, because you don't want those calls, and they may not know it, but they don't want to make those calls to pull money out of the market.
Yeah. Well, I normally don't get those calls. I normally talk to people prior to that, because what we do, even in our IRAs, we do dollar cost averaging. So you're sending money every month in your IRA, or you do a 401k, 403b, and by the time you see the market crash, it's too late to get the money out anyway. To do anything about it anyway. So what do? You're going to call your employer and say, "Oh, my contribution last week, tell them to cancel it." You can't do that.
Right.
That's one reason I love the 401ks and 403bs, because it's direct payroll deduction, and you don't have to worry about timing the market or anything like that.
Yeah. So do you counsel people like on, I've talked to some business owners that are just getting started in trades. They're, they started out as a technician, they saved a few bucks, and then they started up their own business, right? Whatever that is, it's something in skilled trade. So a lot of them are using the Affordable Care Act. And I don't know if you've been keeping track of this, but the subsidies for the ACA, Obamacare is what probably goes short for. The subsidies are getting a shellacking here in 2026. Why they didn't give any runway, I don't know. But anyway, and one of the things is that I've heard is a good idea is that if you're self-employed and you're getting your health care through the Affordable Care Act, that and let's say you're using a payroll service, which I highly recommend, because you're paying into FICA, your Social Security, and all that kind of stuff. Yeah. A 401k will actually help you with your Affordable Care Act subsidies, because the 401k lowers your investments in your 401k, lowers your adjusted gross income. right? Because if you
Yeah.
put $1,000 into your 401k, that investment drops your adjusted gross income. So let's say you make $100,000 and you put 10, I don't know, how much can you put into a 401k now?
Oh, you max out maybe 7, 8. I don't know because they change it all the time.
Yeah, let's just say it's $7,000. I don't know, whatever. When your subsidies calculated for Obamacare, that's that $7,000, whatever that number is. I don't know. But you put into your 401k, lowers your adjusted gross income to $93,000.
Yeah.
And that can help you immensely. Maybe not now, but it can help you. And have you ever run those numbers for any of your clients like that? Or
Well, I tell them all the time, you put $10,000 in the 401k, that's pre-tax money. So you have to worry about it because it comes out of your gross. It lowers your income, taxable income to $90,000 if you put $10,000 in.
Mm-hmm.
So it lowers your income to $90,000. So
That's
now
true.
you only get taxed on $90,000. That's what,
right.
And I love that you brought that up because it's one thing I didn't mention when I was talking about dollar cost averaging and the 401ks and 403bs, because this money comes out pre-tax. So, and then when you leave your employer, you probably will transfer the money over to an IRA, and then money will be taxed now when it comes out, but it was never taxed in the first place.
Right.
So you don't have to worry about when it comes out, that tax. Just the exact opposite of a Roth IRA.
Are you a proponent of Roth IRAs? Do you like those?
It depends what situation you're in, because if you need something to defer taxes, a Roth is good. But then IRA, the annuity could do that same thing. But annuity costs money, but then the Roth does too. So it depends. If the person's maxed out their tax deductions or the 401k at work, or the IRA, and they need or put too much in an annuity, then yeah, I would say eventually a Roth. I'll put money in a Roth. It depends how much I have to work with. If Joe has money just falling out of his pocket, we're talking about a Roth IRA.
Yeah. The problem with a Roth, the only thing about that is once your income gets to a certain level, I can't remember what it is. I tried firing up a Roth through one of my brokerage accounts a while back, and I found out my income was too high. Yeah. They won't let you do it, and I'm like, man, what do you recommend?
How much you make? So you made over $100,000 last year.
Well, I don't make as much money as I used to. I used to make a lot of money.
Okay,
but that's really interesting how that plays out. Gosh, there was one other thing I wanted to ask you about, and it was right in my mind, and I forgot about it.
Before I do a Roth, I'll do a traditional IRA long before I do a Roth.
Okay.
I see Roth as more of a gimmick. I shouldn't say it, but I am saying it. I see it more of it as a gimmick because you can get tax deferred growth someplace else. You don't have to do a Roth for that. And a Roth, you may get confused when you have to start taking mandatory distributions. What
do you think about, let's say you have a client that is a business owner, and it's obvious that they need to get some tax advice. I mean, what's your opinion of bringing a CPA into the fold for a client?
Definitely brings.
Okay.
That's like these skilled trades. Who can do without the carpenter? Who can do without whatever? CPA is a definite must. Is a must.
At what point did you get a CPA when you're still working for a paycheck, or what?
No,
what point
I didn't get CPA then. But when I started hiring people, getting CPA was very important because I didn't know. I didn't know any of this stuff. I didn't know how to pay people. I didn't know how to have assistants. Like you have an assistant. I don't have an assistant. I didn't have anybody. But when I started bringing people on, people that help me set up for the shows, for help fairs and that kind of stuff, then at first I was just paying them cash. But now I have to pay them on payroll. And how I do that, I don't know. I didn't know, but I know now because I have CPA. Well,
I'll tell you what, I've had the same CPA for 30 years, and that guy has more than paid for itself, that relationship. I'll tell you, because the interesting thing, a good CPA, they won't necessarily tell you not to do something.
Yeah.
What my guy does is he basically will tell me, that's aggressive.
That's aggressive. Okay.
Yeah. And then when I'm really falling off the rails, he'll say something to me like, well, Martin, that's an audit magnet right there.
Audit magnet.
And I'm like, oh, And then I tell them, well, you're no fun, that kind of thing. But I've been in my whole career, being a business owner, 30 years, all different businesses and stuff. I've been audited twice. Yeah, 2 times. And the first time it was interesting because I didn't know this. I don't know if you know this, but there's 3 flavors of IRS auditors. There's the ones right out of school that know nothing, 0. The ones that know something and they're medium-sized businesses. And then you've got the top-notch auditors, reviewers that do the Chevrons and the Shell Oil Company. They really know their stuff, right? Well, the ones at the bottom, Enrons, yeah. The ones at the bottom that just came out of school, what they used to do was they'd hang those on anybody when your number came up. And what they did was basically the customer who had the CPA on retainer trained these agents.
Really?
Yeah. So basically what they do, they come in and do your audit, and then your CPA, if they're worth their salt, educates them that, no, Mr. Agent, that's not how you do that.
Yeah, that's good. I like that.
Yeah. So what happened the first time I got audited, I ended up getting money back I wasn't expecting.
Did you? Congratulations. But I noticed a lot of people have had their CPAs for years.
Yeah.
Years. The CPAs just stayed in the family.
Yeah. Yeah. This guy did my dad's taxes. That's how long I've known this guy.
Yeah, that's crazy.
Yeah. So
it's almost like my business. My business is like that too. Because you have your parents and then you have the kids and then have your grandkids. You think you can live forever. I don't know. Hopefully I will. But I might not.
Yeah. Well, cool. So your practice is in North Carolina?
In North Carolina, Houston, Texas, and Greenville, North Carolina.
So where are you? So where's your home base?
Right now, Greenville, but normally Houston.
Okay.
Houston, there's a lot of skilled trades.
Yeah, I know. Yeah. So are you licensed only? Where's your area of business? Can you do business just in those states or all over?
I've got a license in several different states.
Okay.
North Carolina, Texas. I'll get licensed all over, and Minnesota.
Okay.
I bring in licenses as clients come in.
Okay.
The reason I have Minnesota license is because I just got this lady from Minnesota, but she's in charge of women's empowerment, whatever. So she knows a lot of people. So that's why I got the Minnesota license. And Minnesota's freaking expensive, buddy. Expensive.
Cost of living, what you mean?
No, the license.
The licensing.
Yes, I was
okay.
Like, whoa.
Yeah.
Cost like $200. So.
Yeah. So basically, I just wanted to kind of get it out there that you can, if we have skilled trade folks that want to have you help them, you can help them in, as long as they're within those states that you service.
We're licensed in all states except Alaska and Hawaii. That's where we're not licensed.